Hello friends. Before we purchase a stock, initially we'll rely on some technical indicators. All the technical analysts who is following technical analysis will rely on a technical indicator or their own indicator, whatever it is. Right? Or they follow a chart pattern. Right? Based on this technical indicator or based on the chart pattern, will decide whether a stock is bullish, bearish, or neutral. Isn't it? Is that sufficient? Let us take an example. Based on a technical indicator, MACD, RSI, ADX, stochastic, whatever it is, you will take a bullish decision. Even also based on candlestick pattern as well. Candlestick pattern is also giving a bullish signal, and based on that, you take a bullish stance on a specific stock. Is that sufficient? No. We need to pay attention to the internal strength of the market. That's majority of the stock are moving forward, climbing upwards, or majority of the stock climbing down, downwards. We need to assess the internal strength of the market, which is other way we call it as market breadth. Right? So this internal strength, how can we assess? In the last video, we referred multiple indicators: advanced decline line, breadth thrust, McClellan oscillator, McClellan summation index. If you not yet watched the previous video, please take a moment and watch the previous video, which in detail discuss about market internal strength or breadth of the market. So what are we doing right here? We are going to see about the internal strength of the market with a few more indicators. Why are we seeing so many indicators? Why should we aware of multiple indicators? For example, I'm going to a shopping mall to purchase a dress for me. Do I look into a specific dress and pick that specific dress? No, right? I'll view many other options, different colors, different patterns, and then pick a select appropriate dress which I like. Right? Similarly, even in the stock market, there are hundreds of indicators or thousands of indicators. We need not to know all the indicators, but a bunch of indicators we should have aware how it was constructed, how the indicator is reliable in the present day world. Because many indicators are built many decades ago. In that point of time, those indicators were relevant. Now this indicate that specific indicator may not be relevant, right? So we need to review multiple indicators, which we are going to review shortly. So what are we going to discuss? Internal market strength or market breadth and indicators related to that. Without much delay, sit back, focus, and continue. Ratios. Breadth ratios use a ratio between various configurations of advances, declines, and unchanged to develop trading indicators and system for the markets. Using ratios has the advantage of reducing any long-term bias in the breadth statistics. These ratios usually project short-term market directional changes and are of little use for the long-term investor. Here we are going to see about advanced decline ratio. What's the formula to calculate advanced decline ratio? Simple. Number of advances divided by number of declines. When you see the indicator ADR, advanced decline ratio here, if it is high in number, it means fewer declines, more advances. If it is low in number, meaning more declines, fewer advances. Next, we'll discuss about breadth thrust. A thrust is when a deviation from the norm is sufficiently large to be noticeable, and when the deviation signals either the end of an older trend or the beginning of a new trend. This is how the breadth thrust indicator is calculated. It's a 10-day SMA of number of advances divided by sum of advance and declines. We measure the market breadth using number of stocks that are advancing and number of stocks that were declining. Now we are going to measure the breadth using up and down volume. We'll see few significant up and down volume indicators. This is an alternate way to gauge market internals is to measure the up volume and down volume. What is up volume means? Up volume is considered, a volume is considered as up volume when the volume traded in all advanced stocks are increasing. When it is considered a down volume, when volume traded in all declining stocks are increasing, rather than only the number of shares traded, which we do using breadth measurement. This is placing more emphasis on stocks that are actively trading. Just simply measuring the advancing stocks, we are paying little additional weightage on the volume of the stocks as well. With the breadth indicators, a stock that moves up on very light trading is given equal importance to one that moves on heavy trading. When we consider advancing stock, even if it is a lesser volume or higher volume, doesn't make any difference. Even if it advances in lesser volume, will give the equal weightage. But in up and down volume indicators, more weightage to advancing stock with higher volume, lesser weightage for the advancing stock with lower volume. And there is a caveat, like there are dark pools and many traders to go behind the scene to keep things hidden. They'll do off exchange trading, and many of the traders trade using ETFs and index futures. So that may not come into the picture right here. So that is a caveat. So one of the significant index in up indicator in up and down volume is the ARMS index. The ARMS index is also called as trend, MKDS, etc. ARMS index measures the relative volume of advancing stocks versus declining stocks. When a large amount of volume in declining stocks occur, the market is likely at or close to a bottom, right? Conversely, heavy volume in advancing stock is usually healthy for the market. The ARMS index is actually ratio of advance divided by declines, up volume divided by down volume. If the absolute number of advancing shares increase on low volume, the ratio will rise. Meaning, although the number of shares advancing is rising, the market is not strong because there is relatively low volume to support the price increases. For example, let's take an example. Volume is 100 and down volume is 10. 100 divided by 10 is 10. So up volume means volume of all advancing stock. Down volume means volume of all declining stocks, right? Which we saw in the previous slide. So this is 10. Up volume is 100. Down volume is 10. So 100 divided by 10 is 10. Advances similarly 100 and declines is 10. So 10 divided by 10, for example, advances let us take 200 and declines is 10. 200 divided by 10 equal to 20. So 20 divided by 10 will be 2. That's how this ARMS index is calculated. But the ratio thus travels inversely to the market price, tending to peak at market bottom and bottom at market peaks. The inverse relationship can initially be confusing to the chart trader. Similar to breadth ratios, the ARMS index can be smoothed using moving average and tested for parameters at which positions can be entered. ARMS index greater than 1 is considered to be a bearish signal, with a lower level of index indicating a more favorable market outlook. So that's why if you see in the ARMS index, there is a red line. If it crosses, it's considered to be bearish. If it crosses the green line below, then it's considered to be bullish. We've seen various ways to measure the market breadth using advanced and declining stocks, using volume. Now we'll review how to measure the market breadth using new highs and new lows. This is the indicator new highs versus new lows. First, let us see how we use new highs and new lows. A stock is considered to reach a new high if the day's price is higher than the price over past year. A stock reaches a new high when the price is higher than it has been anytime during the previous 52 weeks. Not necessarily when it has reached a new all-time high. When we say new high, it doesn't mean like it's new high forever for the specific stock. No. Compared to past 52 weeks, it's a new high. The number of new highs and new lows is a useful measure of the number of stocks participating in an advance or decline. It is thus an indicator of a continuing trend and usually subject to divergence analysis, similar to breadth statistics. In breadth, we already saw negative divergence, right? We know when stock is making higher high and the indicator is making lower high, that is considered as negative divergence, and it is an indicator that the stock high may not continue further. The raw data of new highs and new lows is subject to the same problem as breadth. What is the problem with the breadth? When there is more number of issues listed on an exchange, for example, if there are 100 issues in an exchange, out of that 90 is advancing and 10 are declining. So we will have a breadth of only 100, right? If there are 5,000 issues in an exchange, so the breadth may expand. So that's why we go for ratios, right? Those similar issue applies over here as well. One of the specific indicator in new highs and lows is new highs versus new lows. How we interpret this indicator? Buy when the number of new highs exceeds the number of new lows on a daily basis, and to sell when the opposite occurs. Interesting aspect of new highs and lows is that they generally peak before the market peaks, similar to breadth line. This extremely reliable observation can warn us when we see a negative divergence in weekly high-low data that a correction is due soon. There are many more indicators mentioned in the literature. I just captured only the significant indicators or oscillators which is commonly used, and all other additional indicators I captured in the description box in my notes. Please download the notes and review the other indicators as well. How do we measure market breadth? We measure market breadth using advance and declines of issues based on volumes of advance and declines and new highs and new lows. Why we need to understand this? Understanding how internal strength relates to broader market momentum is very important. Why it is important? I just explained in the introduction as well why it is important. Review it once if you want to understand better. Unfortunately, traditional indicators perform poorly. In the meantime, analysts continue to develop, test, and refine ways to measure market internal strength. Numerous indicators are present. All the indicators may not be appropriate in the current day market. Analyst needs to develop, test, and refine ways to measure the market internal strength. It is the job of the technician to find what works best for the appropriate trading or investment time horizon. Thank you, friends. Thank you for sticking till end of this video. See you in the next video. Bye-bye.